Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. Let's start with the man, myth, the legend, Mr. Greg Dickerson. How you doing, sir?
Doing fantastic, Michael. How are you?
I'm doing very well. So something we've talked about for probably the last 6 months or so is we both saw rates rising. We saw the real estate market being in a bunch of trouble if rates got to 5%. And if they ever got to 6, real problems could happen. And I think it's fair to say, but I don't want to put words in your mouth. I think it's fair to say, at least in my opinion, rates are shooting up faster than I anticipated 6 months ago. Is that fair to say?
Oh yeah. Mortgage rates, especially. I didn't think it would be going up as fast as they are.
Right. Yeah. So one of the things I've been trying to do, Greg, is I've been trying to look for historical times where this may have occurred. Right. I've been in real estate for 20 some odd years. Rates move all the time. Rates, January to December, can be a point higher, and that wouldn't be abnormal. But when you go up 2 points in 10 weeks, that's pretty abnormal. And I found a point in time where that happened. It was when Paul Volcker was in charge. It was 1979 and 1980. So what I thought I would do is pull up my 50-year spreadsheet, which you've seen. And I think you and I should really dig into 79, 80, 81, 82, because I think it's talking about a housing market that both you and I expect. And I think it could be a surprise for folks. You want to give it a look?
Yeah, let's take a look at it.
All right, here we go. Let me just make sure I bring up the right one. Here we go. So again, folks, a little bit about this spreadsheet. It is something that took a year of my life to put together. I cite all the data sources here. If you want to go check my manual interpretation, it's certainly possible I fudged or mistyped numbers. Go nuts. I cite all my sources. And again, this is free. I give it away for free in my free course. I just didn't know where else to put it, so people go download it. But in this example, Greg, I want to start in 1979. That's column K. Can you see this?
Yeah.
And the reason I want to start here is the interest rate, which is row 7. So that would be this record here. And the reason I want to start here is because what you see for the next couple of years is interest rates shot substantially higher, right? They went up 530 basis points in about 2 years. This is meaningful. This is definitely Paul Volcker trying to break the back of inflation. And again, sometimes people watch this and they don't hear me. I am not talking about interest rates at 11 or 16 in 2022. What I am talking about is a rate of change. These went up 40, 50, 60%. That is what's happening right now. So if we can appreciate what happened in the 79 through 82, we might understand what happens in 22, 23, and 24. Does that make sense?
Yeah.
So the first place I went to look was housing units. So there's generally 2 categories reported: housing, new home sales, right? Builders, which obviously you were a builder in the 2000s, and then existing homes. And what we should do is we should anchor on 79, right? That was kind of the last low rates before they shot higher. And you can see we did roughly 700,000 new home sales in 1979 and 3.8 million existing homes. Then it gets interesting, right? Interest rates take off. They go up, 2.5 points in a year. New home sales fell. I don't know, what's that? 150 units, 150,000, or 20%. And new existing home sales fell about 20% as well. But this continues. One thing is the housing market is not stocks, as you know, Greg, or crypto. It's very sticky, and it takes quarters and years for things to play out. Interest rates again go up another 250 basis points roughly. And new home sales fall again, another 20%. So down 20, down 20. And then new home sales go down about another 20% as well. Or I'm sorry, existing home sales. And then just to round it out, new home sales peak to trough down about 45%. Existing home sales fell 50%. So I thought this was interesting. I would call this a housing crash. I don't know about you, but if it falls 50%, I consider that a crash in transactions. You can actually see appreciation below that, and it was never negative. So
yeah, the prices kept going up during that time, which is interesting.
Yeah, I mean, this is why I am calling for a housing crash in transactions, not price. And the other thing to realize is I have CPI here. Take a look at this. So CPI for you is row 17, kind of down at the bottom.
Yeah.
So in 79, housing appreciation was above CPI, kind of what you would expect. Usually it's 1 or 2%, but start to look at 80, 81, and 82. Inflation was above housing appreciation. So the real rate of housing appreciation was negative. The nominal housing appreciation was positive. This is a very subtle, right? You have inflation of 10%, but housing is 7%. So again, nominal rates are positive, but real rates of housing appreciation are negative. Pretty eye-opening.
It's pretty cool. Go look at 0405 timeframe.
Sure. Here we go. 0405.
Because I want to look at that compared to recent times where interest rates, jacked up exponentially. So if you look at 03, 04,
okay, interest
rates
rates
were low, and then they started popping 05, 06.
Yeah, so they went up about a point. Yeah, 06, 07. Yeah.
So
okay,
look
so
at,
okay.
We'll look at that, and then we'll go to 08, 09. You've got that in the red, so that was a whole nother ball game.
Yeah,
where rates went down.
Yeah, so exactly. So here again, let's do the same thing, right? So interest rates went up about a point. Let's go 04 to 06. So they went up about
that's where they moved.
So what happened to existing? So new home sales went down about 15%.
Yeah.
Existing home sales fell nominally, maybe 5%.
Yeah.
Housing appreciation, again, never negative. CPI was really low. So we were up real and nominal in 04, 05, 06. Now let's go to the.
Now that was the first peak. So 04, 05, that was the first peak of the housing market. Then it cooled off going into 08, 09 when it peaked again.
Yeah. So rates peaked in 08, or actually they peaked in 07.
Yeah.
Then they start to fall. This is very interesting. So again, interest rates are falling. Let's go look at unit count first. Oh, look at these new home sales numbers.
Yeah.
New home sales fell off a cliff. Wow. They went down more than 50%. I had not seen this, or I mean, I put it together, but I had not.
Well, if you look at it, so 6% was your magic number. So 05, it was 5.87. Then 06, it was 6.4. Look at your transactions and your sales.
Yeah, it starts to
start
crack.
Falling off a cliff when it went to 6%.
You're right. Yeah, you're absolutely right. And so again, what's interesting about this time frame, because you and I lived it, others may not appreciate it. New home sales is a very good indicator because those were falling off a cliff. All of these existing home sales, I would guess half of these are foreclosures or short sales. So they were distressed sellers directly from the bank. So these numbers are a little misleading. I bet if you were to calculate existing home sales that were not banks or not distressed, it would be significantly lower than these numbers.
Yeah, and then look at your medium home price. So 2007, according to this chart, was the peak in values, and it was downhill from there.
Yeah, exactly. No, yeah. We had, again, this is the other thing people don't realize. People are talking about a 20% housing crash in a year. Mathematically speaking, that's going to be impossible because the worst year ever, when a Great Recession happened, then the worst year was 9%. And that's with 2 million or 3 million foreclosures. So
yeah,
pretty interesting.
Again, you're talking about median house value. So
of course,
that doesn't really tell you a whole lot because there were markets that did, there are markets and there will be markets that'll drop 50% overnight,
For sure.
So it's all, hyper local, every market's different. And when you're talking about averages, especially in the United States, I mean, you've got $10 million homes mixed with $100,000 homes. So, but still it tells the story. And, when you start going and taking this kind of information and drilling down to certain markets and certain price points of houses, like if you isolated, middle income homes, I think the numbers would be very different than taking, just the median. Like if you took whatever the average, middle class, price point was, during those time frames, that's where you'd see big discrepancies.
Yeah, and this is one of the reasons I get so annoyed with the crash videos, because the crash, if the crash video said, for example, let's pick on Cleveland, Ohio, just because it popped in my head. If a crash video said Cleveland, Ohio, median priced home is going to fall 50%, I would at least dig into that. But if you're going to say U.S. national housing market is going to fall 20% a year, you're smoking crack. The numbers are not there. The worst year ever in an asset at that scale was 9%.
Yeah.
Just not mathematically possible.
Well, and it's different time now too than any of those times, even the 70s. I mean, it's a
Sure.
whole different, animal where your incomes were more relative to the value of what that dollar could purchase based on now.
For sure.
Even with high inflation,
Mhm.
it's a little different animal. And you didn't have also back then, you didn't have the, interest only loan options and
Yep.
all that kind of stuff like you have now.
Mhm.
It's just a different animal. And then when you talk about housing crash and the people that were talking about that, thinking there was going to be these waves of foreclosures and,
Mhm.
all these different things, and what we didn't have in 08, 09 that we have now, or even back in the 70s are, institutional buyers, investors. A third of the housing stock is owned by investors,
Mhm.
individual investors, mostly.
Mhm.
Less than 1 or 2% is owned by institutional
Oh,
investors.
yeah.
But that's growing.
Yep.
So it's a very different housing market now. And what's really interesting, this will be a case study for years to come because
For
housing
sure.
prices are sticky. The question is, as rates go up and the market dynamics change, and we're already starting to see that, how long does it take for housing prices to adjust? We know that transactions are going to
Yes.
go down. They already are. We know that refinances are going down, mortgage applications, all that.
Agreed.
But how long is it going to take for prices to adjust? And what is it going to take to trigger that,
Mhm.
like we saw in 08, 09,
Yep.
and what really triggered it there was you couldn't borrow any money. I mean, that's really what
Exactly.
happened.
Yes. That's why it got so bad and just kept going lower, is because banks
Yeah, even
turned
if you
off.
were qualified and all that, it was very difficult to borrow money because banks were failing. So,
Yeah.
liquidity hasn't dried up. People can still borrow money. Now it might get a little more difficult. You might have to put a little more down and
Mhm.
all those types of things, but the liquidity is still there.
Yeah. The other thing I want to highlight here is wage inflation. Because again, I talk about affordability, it's price, interest rate, and wages, right? It's that triple threat. So wages 79 to 82, just to kind of round out the discussion. We're pretty decent, right? 9% to 5.8. Again, real versus nominal, right? If you take this compared to CPI, you were behind every year. Again, much like today, right? Wages are up 5.2%, but CPI 7.9. Same thing happened 79 to 82. Inflation, which is here 17, was always above wage inflation. So people were going backwards in 79 through 82. This is why the Fed had to come in and pop the bubble.
Yeah. Yeah.
And then it gets better from there. Again, if you go back and look at 83 to 85, CPI is here. Wages are suddenly above inflation. That's Paul Volcker breaking the back of inflation. People did not get ahead until 83, 84, 85.
Yeah.
So again,
but interesting, like I said, even then house prices were still going up because there was a push. So one of the other things that they were trying to promote was home ownership to combat inflation and recession and all those types of things.
Yeah. Yeah. This again, folks, this data is extremely valuable. It allows me to kind of mean test what is going on today. Today, we have interest rates almost doubling in a 10-week period. It has happened before. Go back and look at this data. I give the chart away. I cite my sources. I didn't know where else to put it. So you can go to the link below to my free course, like $0 free. You just have to register on Teachable to get it. It is in the bonus section of that course. Any other thoughts on this, Greg?
No, I think it's good information, good data. It's always interesting to look at what's really happening in numbers. Again, a lot of it's, the housing, values, that's median home price. So it's kind of hard to really put a lot of stock into that, but inflation, interest rates, incomes, those numbers are what they are.
Yeah, I think a spreadsheet like this is very valuable when you look at the big picture, right? Interest rates go up. What happens to the entire market? I think the answer is very easy. Transactions fall, which again makes logical sense. The question I had was how far and how fast. You can see it went 50% over 3 or 4 years. Valuable. Does this tell you anything about your local market? Absolutely not. Does it tell you anything about your buy box? Absolutely not. But you can start at this level and see what happens. And you can start at this level and ask yourself, does rising interest rates, does inflation cause prices to fall? I think we have a pretty clear example. In real terms, maybe. In nominal terms, nope. They keep going up. So Greg, where can people find you?
Yeah, gregdickerson.com. All my info's there. Go check it out.
Thanks, buddy. I appreciate it.